Hi everyone, welcome to another honeystocks.com stock market outlook video for the month of September. Now, before I dive into the charts and of course walk you through many of the charts and the data that I think most of you tune in for, I just want to take the opportunity to thank everybody once again for a lot of the kind messages and emails. I know that my work, certainly with my weekly letter, with my social media analysis videos, etc., has helped many of you to get defensive over the last couple of weeks. So I do appreciate it very, very much. Last week I put out a video just highlighting the potential for the bear market rally to be coming to an end. So if you missed that, I will link it at the end of today's video. As most of you know, I don't use the magical hindsight indicator in a professional sense. I don't think there's many analysts that have called the market as well as I have over the last 6 months. I'm told that my work has been very, very good. But certainly calling the market top at the start of the year, calling the bottom of the market in June, calling the top of the recent bear market rally. I timestamp all my work, which is very, very important in the field in which I work. If you follow, analysts, other firms, etc., hopefully they provide timestamped work as well. I like to keep it simple. My time horizon is generally weeks to months. I think generally with my process, it's really geared towards more of a trend following systematic process with elements of swing trading in there as well. Now, if you do get some value from this week's video, please do like and subscribe. Also, let me know in the comments, do you think we are going to see the capitulation that I think a lot of analysts are calling for? Obviously, the economic turmoil is there for everybody to see. Let me know what you think. And maybe just to give myself a little bit of credibility, I am registered with the CMT Association, working my way towards my chartered status, and please do pause the video and make sure you're comfortable with that very important disclaimer before watching any further. Basically just says that there's not any investment advice, and don't be silly, do all your own due diligence. So let's dive into some charts, let's see what the market's saying. So let's start by talking about seasonality. Now, I will spend just 3 or 4 minutes here just walking through the broader market, the key levels that I think everybody needs to pay attention to, and of course I have some individual charts that I think look quite interesting for the next couple of weeks. But as we can see from the seasonality chart, September tends to be a pretty poor month when we look at the data going back over the last 70 years. It's really about, in my opinion, understanding whether or not we are in a heavy risk on environment or a risk off environment. My work has had a lot of attention over the last 6 months from various sources because I have made some big calls at big moments in the market. When we look at the seasonality, we tend to find that it's towards the end of the month that we get into difficulty. These are charts that I communicate to our clients and members every single year, so I'm quite used to the whole September effect and what it potentially means. We are of course seeing some big pressure in the major averages. Again, I will get to those charts in a second, but if we can understand the wider dynamics of the market, we know that the yield curve has already inverted. We know that when it does invert, it drops below zero, and these shaded areas tell us that we get a recession shortly thereafter. And we also know stocks don't tend to perform particularly well during recessions. Now, it's probably worth mentioning that the stock market on average tends to bottom 6 months before the economy. So I don't subscribe to a lot of the scaremongering and the economic turmoil, because the stock market will bottom before the economy does, and that's something that price helps me navigate. We already know that consumer credit is reaching all-time highs versus a personal saving rates that's plummeting. We know we've got negative GDP. We already know that the CPI is ripping. We know that the S&P 500 is under a lot of pressure at the moment. So this is all information I like to pay attention to. My work really focuses primarily on technicals, but there are elements of fundamentals that I like to utilise within my process. I think if anything, the market has taught me that fundamentals do matter, especially over the last 8 months, and that's something that I've incorporated into my work. We know, again, this is a chart, the US dollar index just helps me to navigate whether or not we are in a risk-on, risk-off environment. As a European, it has been the easiest trade of my life to just hold US dollars over the course of the last 6 months. We know certainly that with the monthly chart, we've got big targets. Let me just tidy this up. We've got big targets here on the US dollar. We can look at this as $120. Now, given the negative correlation with the S&P 500 and the US dollar index, we know that when the US dollar index has been ripping higher, we can see the inverse correlation and the S&P 500 has been going lower. So the message over the last 8 months has been dollar up, stocks down. I would hope that most of you have figured that one out. It's something I've been covering for the last 6 months. But the big question is, like I said, if we have an environment where we have dollar up, stocks down, and we have the dollar going towards our upside objectives here dating back to the 2001 highs, if the US dollar index reaches that 120 level, what would that mean for stocks? I don't think that's a great environment. So again, it is another headwind for stocks. I would like to see the US dollar index cool off a little bit. I think that would help stocks, but there are so many different narratives. There's Russia, Ukraine, China, Taiwan, inflation. There's so much out there that it's very, very difficult to be completely bullish on the market. So it's really about understanding whether it's risk on or risk off, like I said, and picking spots here and there, not being aggressively long or short. And that's the way that I'm currently viewing the market. We can look at the S&P 500. For those of you that have been picking up my work over the last couple of weeks, you'll know that I've highlighted the 200-day simple moving average as a level to keep an eye on. Now, again, not using any magical hindsight indicators here. My work has all been time-stamped with this. But we've had a 10% decline in the S&P 500. Now, that's been great for, I think, those that have had hedges on or maybe taking positions and things like inverse ETFs, etc. But what I like to pay attention to is over the last couple of days, I was looking at this level here as a potential support level. We did get a little bit of a mini rally, but when we start to run into these moving averages and the stocks sell off, again, that's information I want to pay attention to. A lot of analysts, I guess a lot of traders, etc., maybe don't realise that it's not just about price and understanding support levels. We can also get logical turning points with RSI momentum. As we can see over the course of the last 8 months, is when RSI gets to this sort of range, we do oftentimes get these rallies. So I'm reasonably hopeful that we can get some kind of rally, but like I said before, if we start to break below these levels, I think there's probably a test of those June lows in store. And again, that would be a risk-on environment. And of course, it would be an environment where you probably want to have some kind of hedging in place. The same goes with the triple Qs. It's down 12.5%. Again, if we start to break below these levels, there's probably a test of those June lows. I think with the Dow, I think we were down 8.5% from my bearish call, and again, I think if we break below these levels, again, I would expect a test of those June lows. Again, same with the Russell 2000. The message that I've really been communicating to our clients and members over the course of the last couple of weeks is really just to assess the charts for the positions that you are looking to enter into, and not overthink the broader market too much unless you are, of course, taking positions in the major averages and those inverse ETFs, etc. Some names now. What I would say is with a lot of the charts that I'm about to walk through and present, a lot of my work at the moment is really geared towards picking up potential support levels in stocks that are already in big declines. Now, Google is obviously one of those mega cap tech names, safe stock over the long term, but I'm just looking for optimal positions to enter into top quality stocks with decent fundamentals. Just draw your attention to this area of my chart. But I think there might be an opportunity with Google to maybe buy in around $100. I think the stock is currently range bound at the moment. We know that with range bound stocks, it's really a case of buy at the bottom, sell at the top. And that's something that I'm very much looking for with Google at the moment. Same with Netflix. For full disclosure, this was a recommendation to our clients and members. I did also cover this in one of my weekly letters on this breakout. It did meet a logical upside objective level, but I think we're potentially building a cup and handle pattern. I think the pattern would need to complete. I think we do need to get above 250 there, but at the moment it is chopping about sideways, but there is the case to be made that we're looking at a potential cup and handle pattern, or there will be an opportunity to buy it around 200. I think with Apple, I've got my eye on this 130 level for this pullback. Again, Apple has been showing incredible relative strength over the course of the last few months. It got very, very close to hitting all-time high levels. It has fallen away with the broader market, as you would expect, over the last couple of weeks. It's down, I think, 11.5%. But again, I'm just looking at these support levels for optimal buy points. Now, Nvidia has been absolutely crucified. I think that's probably fair to say. Over the course of the last couple of weeks, we had earnings, and then, of course, the whole did Pelosi know? Didn't she know? I'm pretty certain she knew. There's a lot of nonsense and headlines, I guess, with the whole China situation. So again, I'm looking at support levels here, maybe 135, and then I think if we break below 135, I think there's probably an opportunity to buy it around 116, 117. I know there's probably many of you that like to dollar cost average on things like Nvidia, which I completely understand. That many of my clients like to dollar cost average on Nvidia also. So just looking for optimal points where it could make sense to buy in. What I would say is that RSI has reached an oversold level, which we can reasonably expect some kind of rebound, whether that's short term or not, who knows. But we are at a level here at 135 where we could potentially get some kind of rebound. But I think it's probably a case of, it's going to be market dependent, and what happens with the broader market next will probably influence, I think, what happens with Nvidia. I get a lot of messages on Amazon because I made some big calls on Amazon over the last few months. I made a bottom call here on Amazon at 100. I made a top call, target levels, etc. Again, I don't want to appear that I'm using any magical hindsight indicators. I actually did an analysis on YouTube on Amazon a while back, highlighting this chart, and of course it looks to have played out. So I think for me, either it's going to be range bound or it's going to rally hard here and break out above 150. But either way, I wanted to cover Amazon because I get a lot of messages on it. For me, it's now in the middle of no man's land. It's one of those companies where you can probably dollar cost average on. But I think you need to be aware that Amazon can do a whole lot of nothing for a very long time. As we can see, it's one of those stocks that can chop about sideways for a couple of years and do nothing. So that's something to be aware of. Now, some of these charts, again, I have covered already with our clients. This last week was put out as a short. I think emerging markets, I think when we understand the whole China situation, Taiwan, etc. Emerging markets, if you don't know, is made up roughly 40% China. So I think the 100-day simple moving average looks to be a tool that you might want to use for this type of chart. Again, not every chart is the same, and I think this is something that I think is lost on many traders and analysts. It's really about figuring out what tools work for each individual chart. And as we can see, the 100-day simple moving average, very basic tool. We can see that for this particular chart, the tool has a lot of merit. So I think around $38 would be a bearish target level for those that have, I guess, moved in on this one. And I think if there's a further breakdown, then that would be an environment where emerging market are obviously not doing too well. To the other side of things, we've got defensive areas of the market, utilities, American Electric Power Company, for example, patiently waiting for a breakout above 105. ConocoPhillips, again, for disclosure, this has been a high conviction recommendation on a breakout above 100. It's obviously doing very, very well. There is an upper target here of around 122. But again, I think it's going to be very, very dependent on what happens with the broader market. We know that the energy names have been ripping and done very, very well of late. So we'll need to see how that one plays out. Microsoft, I think, is at a big level here for the stock. Dating back to 2016, this trend line has been acting as support. Again, I have been highlighting this for the last few months. A lot of the mega cap tech names have been I guess, areas of relative strength in the market. So the big concern I have here is if we get an environment where Microsoft's breaking down, where Apple is dropping to next support levels, we've got Google dropping to 100, what's happening to the S&P 500 in that environment? I don't think that's particularly good news. So again, I would go back to what I was saying at the start. Are we risk on or are we risk off at the moment? And I think for me, it's lending itself more to a risk off environment, and that's really how I'm viewing it. Some sideways moving stocks. I think for me, picking and choosing spots is of course very, very important. I think we've got CrowdStrike, which negative earnings data, in my opinion. But we are now a big support level. We're in a sideways range. Now, I like range-bound stocks because it's very easy. You buy at the bottom, sell at the top, and if it does break down, you either have an easy out or you can maybe take a short position or buy some puts on the stock. And I think for me, when we have stocks that don't have a PE ratio, for example, I think those are the types of stocks that have been certainly taken out to the woodshed over the last 8 months. Again, same with Roblox, a very high risk, high beta stock. It didn't break out. It's in a sideways range at the moment, and again, exactly the same kind of situation that we have with CrowdStrike. We're seeing it with Roblox as well. Again, consumer staples names. McDonald's looks like it's building a bit of a base there, so I think that's worth adding to your watch list, potentially for a breakout. We've got ExxonMobil, met our target a couple of months ago. So I think it makes a lot of sense to pay attention to XOM, XOP, etc., because that will give us some kind of sense of what is going to happen with the energy names next. I think there's maybe a little bit of room to go, as we've seen with ConocoPhillips. I think the same probably applies to ExxonMobil as well. We've got Micron Technology. I think above 67 it makes more sense, but as it stands at the moment, I think we're in a bit of a bearish environment. We've got GPC. Again, there are stocks that are holding up very, very well. I have covered this stock a few times, and again, the trailing stop losses are still holding up. And I try not to second guess what comes next. I like to have a systematic process that will just automatically take positions out, and it just removes a lot of the guesswork. We've got General Motors above 41. Might make a lot of sense. Announced recently a $2 billion share buyback and also a dividend. Now, I get a lot of questions on Freeport-McMoRan, so I just want to quickly touch on this one. For those of you that don't know, I made a big bottom call on Freeport-McMoRan a couple of months ago, purely based on RSI, just showing that when we get to these levels, we tend to get these rallies. Now, something I like to pay attention to with RSI is if RSI cannot reach an overbought condition, which is a characteristic of an uptrend, you tend to find that if a stock is going to continue on its downtrend, generally speaking, RSI can't get above 60, which is exactly what we've seen here with Freeport-McMoRan. It made a 32% move from my bottom call, but you need to have a look at what the individual sector is doing, and the copper miners ETF has run straight into resistance. And of course, what's happened with Freeport-McMoRan, which is a great company, low PE ratio, solid earnings growth, etc. I completely get it. But when we have an environment where the copper miners are running into resistance, that will show up in the individual names, and I think that's what we've seen with Freeport-McMoRan. Now, the other thing to say is if you are still hanging around here, please do hit like and subscribe. It tells me that you're getting a lot of value from my work. Now, we also have T-Mobile here. Now, for me, this is a Fibonacci chart. In the same way that emerging markets was a simple moving average chart, I think T-Mobile is a Fibonacci chart, and I think, as we can see and as the chart can demonstrate, these Fibonacci levels do matter for this stock, and I think if it breaks out above 150, I think it brings in a decent upper target level there of around 225. But again, it will depend on the broader market. We could quite easily just see the stock just stay range bound here and chop about in this sideways range. But I think it's worth adding to your watch list in case there's some kind of news catalyst that can take it above that 150 level. So, like I said, if you have had value from that, please do hit like and subscribe. If you are somebody that does struggle with the markets or you're being chopped about day trading, etc., feel free to stick around for a minute. Little bit of an announcement to make. But if you are new to my work, or maybe you have just stumbled across me on social media somewhere, feel free to check out our website at honeystocks.com. We provide technical charting research to professional and retail investors all across the world. And what we provide with our memberships is access to our premium weekend analysis, which provides all the updated charts, real-time charts as well, and we put that out every single weekend to our clients and members. We also provide a midweek halftime report which updates all of our charts and analysis. We provide high conviction investment alerts, which I will show you what that looks like in just a second. We provide access to investing and trading community, which is made up of investors and traders from all across the world. We've got access to our ETF and our commodities chart book and all of our updated charts. We also provide access to our technical analysis program, which I'm told is exceptionally good, and that's provided with all of our memberships at the moment. But just to show you what our high conviction alerts look like, I touched on ConocoPhillips in the analysis. This is the alert that went out to our clients and members. Provide steel index again, which was a decent winner. Flexible long or short, I think that's something else to say. This was a recent short idea on the commodity index, which met our downside objective. Same with Zillow. Box again met our downside objectives. But I'm very, very unique in what I do. I timestamp all my work, like I said before. I log for complete transparency every single high conviction alert that has ever gone out to our clients and members over the course of the last 4 years. So feel free to go and check that out. It should help you to understand that I'm looking for high quality stocks. You can see the dates that they've been recommended, the price that they've been recommended, and what that stock has then gone on to do. And like I said, I think there's only one or two other firms that provide the same level of transparency. So again, feel free to check that all out. But I think if you are somebody that is being chopped about at the moment and you have a mid-term approach, maybe you are looking to get away from day trading because the penny has dropped and you realise that it's just not consistent. Maybe you are just too busy with work, family, life. Maybe you want to be part of a community and you're sick of hunting around social media for lots of ideas. Feel free to check out, again, our website and see if it's a good fit for you. But at the moment, it's probably worth saying that with our analysis at the moment and with our work, we're doing a 3-day event for Labour Day weekend, which is obviously a public holiday in the US. So that offer will end on Monday. So again, feel free to go and check that out. But if you have stuck around to the end here, thank you very much for watching, and I hope to welcome you soon. Thanks.